many people's minds, the financial crisis was caused by Wall Street, and unfortunately all companies got into, when the politics started looking at what was the root of that, there was a lack of confidence between investors and the board and management. So as the politicians moved into Dodd-Frank and tried to fix this, they wanted to bring that closer. And in the way to move that closer was to move from an environment of just transparency of companies to creating an environment of engagement. So really Dodd-Frank is moving to where companies and investors are going to have a lot more engagement. When you look at Dodd-Frank, one of the big focus areas was compensation and trying to tie compensation into long-term performance of the company. And when over the past few years, we've had this look at short-termism versus long-termism. And when you look at it from a company standpoint, short-termism is when a company is too motivated by short-term interests and not looking at the long-term focus or long-term interests of the company. Well, we have the same thing on investors' side, where investors have gone from a long-term investment strategy to what's a much shorter time frame. Many long-term investors see 6 months or 9 months as a fine holding period and consider themselves long-term. So in changing this environment from a company standpoint, we're really trying to focus compensation in on making sure it is equated or aligned with the long-term interests of the company. And that's a little bit of a challenge. During the recession, there was a big push, and so companies started changing compensation back to stock performance. And they did that at the low of the stock market. And then suddenly everything came back, and stocks have since doubled, and that compensation doubled. And so now investors are saying, whoa, we're not sure exactly that's what we mean. So over the next few years, we're going to see a process where companies and investors work through that and come up with a strategy that makes sense. And one of the tools that investors have is what's called Say on Pay Now, where investors will have an advisory vote on what they think about the compensation of the companies. For investor relations officers, the real challenge is how do you tell investors as much as possible, not giving information to the competitors, obviously, but try to be as transparent as you can. And when you look at investors, there's really different types of investors. There's retail investors, and there's very much institutional investors and pension funds, and each have different interests and different focus. So for an IR professional or investor relations professional, it's a matter of providing the plethora of information in the many means of communication as possible. So there's written communication, there's communication using videos and that type of thing, there's social media, and there's all sorts of ways to get your message out. Our capital markets are changing, and we've talked about long-term and short-term investor time horizons, but we also have a whole plethora of users of the market that are traders, high-frequency traders, and people that get in the morning and get out in the afternoon. So they're renters of the company and really not investors. So from an IR standpoint, as capital markets evolve, we need to evolve and make sure we understand who's using our stock and separating the traders from the investors and focusing on those that are long-term holders. So that's one. Social media is another one that I mentioned. And social media continues to evolve. We see Twitter, and we all personally probably use Facebook, but Twitter is another means to create a bigger microphone and get our message out as communicators. So we want to take advantage of that, but it's all a matter of how we work with that and understand too that social media allows us not to just communicate outward, but it also allows us to listen. And we often think of communications from a company standpoint as just outward, but we're really moving more into a time frame where we can listen too. And Twitter is one of those, as well as the other social media where consumers or investors can come right back to you and tell you what they think. So those are a couple. Certainly government regulation is the third, and we're seeing lots of change in government regulations, certainly during the first 2 years of the Obama administration. What happens over the next couple of years as Congress becomes and the White House become a little bit more equal partners in this. And so the SEC, where I focus and communication focuses, there's a lot of Dodd-Frank that they need to implement. There's a lot of looking at capital markets and catching regulation up to our market structure. And then from there, we see a lot of enforcement. And enforcement right now is an area that we're trying to get rid of the bad actors in our financial markets.